Good evening, everyone, and welcome to the Henry Schein Dental Academy webinar series. My name is Adam, Marketing Specialist, and I'll be your moderator. We're excited to welcome Dr. Tom Snyder and Eileen Anderson as our speakers tonight as they provide an update on practice valuations for 2021. Tom and Eileen are both with the Henry Schein Professional Practice Transitions. Tom is the Senior Director and Eileen is a Transition Sales Consultant. Before we get started, we have a few reminders for you. At any point during tonight's webinar, if you do have questions, please type them into the Q&A section of your control panel, and we will get back to you with an answer within 2 business days. Henry Schein is not offering CE credit for viewing or attending this presentation live or on demand. And this webinar is sponsored by Henry Schein Professional Practice Transitions and Dental Business Institute. Tom and Eileen, welcome. Take it away.
Thank you. Thank you, Adam. Good evening, everyone. I'm glad you're able to join us for what we think is going to be a very informative presentation about practice valuations. Some of you may have attended some of our prior seminars when we were in the midst of the pandemic. We made several predictions, voiced several concerns, and I'm happy to report there's a lot of good news that we're going to be sharing with you tonight about the value of your dental practice or practices. So tonight we're going to cover a few things. We're going to kind of review the pandemic's impact on practice values and how we see it in 2021. We're going to look at common valuation methods, and Eileen will be covering that in some detail. We're going to look at how we are factoring in the shutdowns that all of you experienced in 2020 and how that is going to impact your practice value. We'll also review the top 5 factors affecting a dental practice's value. Eileen will cover with you developing an emergency exit strategy and why it's so important to have one. I'll be reviewing strategies on valuing practice record lists. There's a lot of reasons to value your practice, and it's not just for a practice sale. If you're thinking of bringing an associate in to become your first partner, or you are partners and maybe haven't figured out how you're going to value the buyout, valuations are important. We're going to stress the importance of every doctor having an emergency exit strategy. For those of you who are involved in estate and financial planning, practice values are a very important component of that process. Many doctors now are thinking of merging, so practice valuations become critically important. Unfortunately, if someone's involved in a matrimonial or partnership divorce, there are valuation methodologies that can be used to handle that. For you doctors who have a C corporation, there may be requirements when you do a transition to have the personal goodwill valued, and there are valuation methodologies to do that. Finally, for those of you who have or are considering converting from your C Corp to an S Corp, there are certain requirements for valuation that are needed when that event occurs. So you can see there's lots of reasons to value your practice. So let's take a brief look at the practice valuation landscape pre-pandemic. As most of you know, it has been a seller's market for some time, and we're going to touch on that in a few minutes. Since it is a seller's market, that means there are more purchasers than buyers. The average retirement age has been steadily increasing and reached a high of 69.1 years in 2018. And this data for 2020 was just released recently. And believe it or not, the retirement age has decreased by about a year. So I think we saw the peak of doctors who were practicing longer. And a lot of that had to do with the Great Recession. Many doctors who might have been in their early 60s, late 50s, wanted to sell their practice, maybe 2009 or 10, 11, and 12. And all of a sudden, along comes the Great Recession. And there goes 30, 40, 50% of a doctor's retirement assets. So what were their choices? For many of them, they had no choice. They had to remain in practice Many of those doctors maybe started to cut back, but they still needed to stay in practice to catch up. However, as the market has been improving over the last couple of years, many doctors began to feel comfortable and they began to retire. And then, of course, along comes COVID in 2020. And as we'll discuss briefly, that again has made some big impact on doctors' planning. Particularly before the pandemic hit, DSOs were purchasing practices at premiums in many markets. And although DSOs kind of took a pause in the first and second quarter, for the most part, when there were the major shutdowns, they're back in action. There's plenty of private equity money out there, and they're back in a robust fashion purchasing dental practices. However, this is not the purpose of tonight's program, but there have been a number of changes in how DSOs go through their transaction process. Also, we'll see that shortly, continuing the shift between the annual number of retirees versus dental graduates. So let's take a look at what are some of the key points that we've learned as a result of the pandemic on our dental economy. Many of you might have attended programs sponsored by the American Dental Association's Health Policy Institute. And back in March, they initiated a biweekly poll. And then every 2 weeks, they would ask a series of questions and also calculate a number of statistics from the respondents. And this survey has been a statistically valid sample. It started out with 12,000 dentists, evened out to about 6,800 for a number of months, and most recently is at about 3,000. But still, these are valid statistics, and we've learned a lot. And many of you may have attended these and have followed it to see how you relate based on other doctors. So some of the metrics people looked at were staffing, PPE supply, which was a problem for certain dentists in parts of the country. They also wanted to look at the type of practice. They also looked at the age group. They looked at specialties. They looked at patient volume, collections, and other metrics. But the one thing that was really remarkable about this program, you could see trends developing and get some really good feedback. So I'm going to share with you the most recent information that was released as a result of the January 18th panel. And what we found that when we were in the midst of this pandemic, everybody thought doom and gloom. Practices were closed for 1 month, 2 months, 3 months. And so we had no idea where things were headed. But what we learned is things have kind of stabilized. And what the ADA found is that patient volume and collections were estimated on average at 80% of pre-COVID levels, which means if you look back at 2019, the average doctor, be it specialist or general practitioner, was at 80% of what they were doing in the prior year. Now, not everyone did as well. Other doctors did better. So an average, as you know, is an average. So it was a lot better than most people thought, to be perfectly honest with you. The other thing that was very interesting is that from a standpoint of dental personnel, the staffing today is at 99% of pre-COVID levels. Yes, in April, we had 500,000 people get furloughed, but everybody came back. And what's interesting now, when you look at certain job classes where there are problems in our profession, are hygienists and dental assistants. We had a number of hygienists who elected to retire. We also had hygienists who may have been working part-time, where because of learning at home, they had to be there and they couldn't work. The same thing with dental assistants. So in certain parts of the country, this is still a problem. From the associates' point of view, they took a big hit back in the first and early second quarter, where a number of them were furloughed, but associates are now back to about 75% working full time. So that's all good news. Now, there were some interesting questions that I think have some implications here. Asked the respondents, and they started asking this question back in October of this past year. And what they asked doctors was, what happens at the end of 2020 if things aren't where they were or close to where they were in 2019? What would you do as far as your behavior and patterns? So the question was asked, and as of January 18th, nearly a third of dentists raised their fees because PPE expense and others. Others responded to the financial challenges. They applied for additional PPT funding and bank loans. And some began to reduce staff hours because remember, if you're at 80% on average, you may have some slack time, right? Now, for some practices, that didn't happen because they might have been at 100% or even more than 100%. But doctors who may have been less than 80%, maybe 70 or 60, that had some implications. Retirement rates have not yet changed as was previously predicted, but we feel it's still too soon to tell if there will be a spike in retirements for those over 65 years old. And I'm going to cover that in a little more detail in a minute because we think there is something going on right now that has some big implications for doctors who are over 65. The other thing that's heartening is that consumer confidence has really returned. And 88% of patients have already returned or are ready to visit the dentist. Now, this consumer sentiment came from an affiliated company that worked with the ADA, who does consumer research. And the people they surveyed were patients who had gone to the dentist for years. So we found that 12% still will not return until COVID is under control. So now you can see that 12% of patients kind of contributes to part of that 20%. So that's something that is there. It hasn't changed. And hopefully, as we have all these vaccines becoming available and we're really getting some good news, I think that's going to get better. Now, let's talk about the doctors over the age of 65. As you can see from this graph, on the left, we have about 33,000 active practicing dentists 65 or older. That's why, we look at our profession. That's why the retirement age has been relatively high. And if you look at the second bar, you'll see that we have about 45,000 dentists who are aged between 55 and 64. So it's fair to say that our profession is slightly older. Well, with the 65-year-old group, questions were asked about what would you do in 2021 if, in fact, patient volume or collections were not where they were in 2019. And surprisingly, about 40% of the doctors said they would either sell their practice or retire within the year. Now, of course, I shared with you the statistic from the January 18th situation, and that really didn't happen yet. But from our associates in the field, we find there's a number of doctors now who are thinking of retiring. So that's something that we're going to see, which is going to lead to the next point. I said before that it's a seller's market. The most recent data that we have available from the ADA's Health Policy Institute is 2018. And we had about 6,200 doctors graduating from dental school and about 4,800 doctors retiring. But if things keep progressing the way we feel they will, I wouldn't be surprised, and this is purely a projection, that in 2021, we'll finally reach that crossover point where we will have more doctors retired than doctors graduating. So what does that mean longer term from a practice value point of view? It means that it may eventually not be a seller's market. It's not going to be an overnight change, but it's something that everybody needs to know when you're considering, especially a 5-year plan. So, what about the impact of practice values this year? Well, we said before, in most markets, it's still a seller's market. And clearly, if we look at that magical 80% of 2019 pre-COVID levels, we really do not think there's going to be a material impact on value because we have to factor in the fact that practices were shut down for 1, 2, and 3 months. So we think 2021 is going to be a little better than most people had predicted. However, those practices who had lower comparative patient volumes and collections may be valued lower. And where we see this happening more than anything else is doctors who are over the age of 65 who are solo practitioners. They had the biggest struggle. They had the biggest struggle in many markets with PPE. They had the biggest struggle in keeping staff or paying staff and just being busy. So that's where it is. Another thing too, if you're thinking of selling your practice and you want that purchaser to get a bank loan, don't be surprised as the lenders are going to ask for a lot more data. And they're going to look at a month-to-month analysis. They're going to look at quarterly trends. They're going to look at 2019 because they want to see to make sure if they're going to loan money to a purchaser and if the value is not much different than what it would have been had we valued it in 2019, they want to be sure that doctor's going to be successful in 2021. So hence a lot more information. So let's look at what dental practices are worth. Pre-COVID and remains to be seen post-COVID, the majority of practice values, both specialty and GP, vary between 60 to 80% of prior year's gross revenue. Now, that is the majority. That means we can have practices worth less and practices worth more. And the reason there's a big variation is because of geography. It's all about supply and demand. The more dentists, the more purchasers, you begin to see relationships. If you go to a small town or rural area where there's not much demand, well, practice values are going to be lower. And when we value a practice, we use the term transaction value. And that's defined as the price that the practice assets are likely to bring as a going concern in this particular geographic area. Practice values have two components, intangible assets and tangible assets. And we found on average that no matter whether it's a specialist or GP, if we look at the value of a dental practice, approximately 75% is intangible and 25% is tangible. Tangible assets are pretty straightforward. Dental and business equipment, technology, instruments and supplies, and leasehold improvements if the doctor is a tenant. Intangible assets, goodwill, restrictive covenant, patient list, and phone number. Phone numbers become particularly important in multiple location specialty practices as well as multiple location dental practices. Eileen's going to be talking to you in a minute about how we value practices, but what must be remembered, and many times our clients forget this. So here we go. We're going to review it one more time. The exceptions to value are accounts receivable and cash are not included, as well as liabilities. So we have to really look at those three asset classes and factor them into the calculation, particularly if this valuation leads to any kind of a transition. So now I'm going to turn things over for a while to my colleague, Ms. Eileen Anderson. Eileen has been working with me closely for the last few years. She now is actually doing the majority of our practice valuations. And I will introduce you to Eileen. Take it away.
Thank you, Tom. We're going to talk about common valuation approaches. We use 2 to 3 methods, depending on the practice, to establish a market or a transactional value. Let's walk through the methods. First method is a market approach. Sounds just like its name. What are other practices selling in that market? And market to us means geographic area. We call this the Guideline transaction method. How do we do this? First thing is we start with databases. These are private databases you subscribe to, and they usually cover large geographic areas. So the Northeast or the state of Florida. But they do give us an idea, at least in those large geographic area, what practices have sold or transacted for previously. Two of the databases that we use are a Goodwill Registry and Pratt Stats. We also review Henry Schein transactions. We are in the business of selling dental practices, and so we do have a database of transactions that we have or practices that we've sold over the years, and we look at that. We also have the opportunity to have our transition sales consultants that are in the field go look at the practice that we're valuing, as well as they're experts in their specific market. Sometimes even in the same city or town, one part of town might be more desirable than another, and that may have an impact on the value of a practice. There is a variation on the market approach, and it's called the gross revenue multiplier method. It's a rule of thumb method, and it basically take a percentage and apply it to a practice's collections for the past year, or sometimes they apply it to the average of the past 3 years. This method only looks at collections. It leaves out the analysis of cash flow and valuing the net assets. If a doctor uses this method, they could be undervaluing their practice. It's certainly worth the time and the energy to look deeper into a practice. But let's understand how this method works. So we're going to look at practice A. We're going to assume a 70% multiplier. So the gross receipts or collections is $400,000. You multiply that by 70%, and the value of the practice is $280,000. So we have practice B. Practice B is $600,000 in collections or gross receipts multiplied by 70%, and the value of the practice is $420,000. This is how you would apply this gross revenue multiplier. We never looked at profit. We never looked at the underlying assets. So let's look a little bit deeper. So practice A has gross receipts of $400,000 and an overhead of 50%. So the overhead calculation is $200,000. The way to think about overhead is for every dollar that comes in collections for a 50% overhead, 50 cents of that dollar that came in is used to pay fixed and variable expenses, things like staff salaries and rent and dental supplies. So if we take our gross receipts of $400, subtract our overhead of $200, the net income is $200,000. So let's look at practice B. The gross receipts were $600,000, but it has an overhead of 66 2/3%. So for every dollar spent, 66 cents is what those fixed and variable costs are. So that equals $400,000. So the net income is $200,000. So which practice would you buy? The practice that they both have net incomes of $200, but one had gross receipts of $400, but this other doctor had to work a lot higher for gross receipts of $600,000. Yet this practice A was valued at $280,000, and practice B was valued at $420,000. Here's the problem with just applying a gross revenue multiplier. The second approach we use is the income approach. We start by calculating a benefit stream. So I know everybody's asking, what is a benefit stream? It's really the cash that comes out of the practice after expenses. And when we calculate a benefit stream, we calculate it for a normal doctor. Now we know that there's no such thing as a normal doctor, but our goal is to take individual doctor decisions out of the benefit stream. For example, one of the adjustments we might make is to remove a doctor's pension contribution that's on the tax return. Every doctor may make a different decision on pension contributions, from no pension contributions to maximizing out the contribution. By removing this, we've taken that individual decision out of the benefit stream, so it's easier to compare practice to practice. So let's look at what I'm talking about. So we start with net income. We're going to subtract discretionary expenses. Discretionary expenses are things like continuing education, CE, travel, and pension. We're also going to subtract or add normalizing adjustments such as rent and supplies. And what we end up with is a benefit stream for the practice for a normal doctor. So let's dig into some of these items so you understand what we really are talking about when we talk about discretionary expenses and normalizing adjustments. So discretionary expenses are added back to net income. So one discretionary expense might be continuing education. Another would be travel. Some doctors run their automobiles through their practice. Gifts and contributions. Again, doctors may make different decisions related to gifts and contributions. Certain insurances, for example, medical insurance. Owner's pension contribution, which we just talked about. Maybe family member compensation. We have doctors who pay their daughter or their son to manage their social media. Or maybe they use their images in their advertising. Perfectly legal, and it's certainly a deduction on their tax return, but a potential buyer may not need those expenses moving forward, and so we will pull those out as well. The other thing we do is we normalize certain expenses, so things like dental supplies. So what we do when we normalize expenses is we look at industry averages. So we normalize dental supplies if they exceed 10% down to 10%. We also normalize office expenses. Every dentist would make different decisions related to office expenses, and so we use an industry average, and if office expenses exceed 2%, we would normalize down to 2%. We also normalize rent. Some doctors own their property and there's no rent on their tax return, but if a buyer was going to buy that practice, they would have a rent expense, either renting from the doctor who owned it or a mortgage. So we do normalize rent expenses. Professional fees. Typically, we normalize them if they're consulting services. We don't usually normalize accounting or legal or IT, but maybe the doctor has had a consultant come in and help train the team. That might be a one-time expense, and so we would normalize that out. Talking about one-time expenses, we normalize those out as well. Such an example would be repairs due to flood damage, or if there, something unusual happened in the practice and you had a one-time large expense, we would typically take that out as a normalizing expense. Normalizing expenses don't always increase the cash flow of a practice. In some cases, we have doctors whose spouses may work the front desk but don't get a paycheck. Well, a buyer who buys that practice is going to have to pay someone to work the front desk. So we, in fact, would add the expense of a front desk staff person when we were trying to come up with that benefit stream. Here's an example of what adjustments to our income statement would be for normalized expenses. We start up here with the earnings from the tax return. We make our normalizing adjustments, and we work through a number of calculations. One of the things I want you to notice is we normalize expenses for every year. We don't just normalize the previous year. We want to look at the practice over time. Once we have our benefit stream, how do we use it? So we basically use it to determine the earnings available for distributions to owner. What are the sustainable earnings before interest and taxes? We consider various risk factors and then arrive at a return on equity that will determine a capitalization or a cap rate. The higher the cap rate, the lower the value. The lower the cap rate, the higher the value. And right now, interest rates are incredibly low, and that does impact our cap rate. So our cap rate is relatively low, which creates higher values. The result of this is an estimate of value based on the present value of the future economic benefit. Prior to 2019, we used a single period capitalization method. Because the dental industry was relatively stable, we were able to project out earnings using just a single model. But 2020 has changed everything. It was a difficult year and it was a one-time event. In order to take that event into consideration in our evaluations, but not let it drive value, because we don't think this is a permanent change for dental practices. We've changed our methodology and we're using a discounted cash flow method. So the discounted cash flow method allows us to consider shorter and longer term projections. It allows us also to project what that 2021 cash flow might look like, what that revenue might look like in 2021. And to do that, we've determined that we need to do some additional analysis. So we are collecting some extra data from our doctors, days open and days closed in 2019, days open and day closed in 2020 by month, as long as collections and productions. And using that data, we're able to run several analyses that say this doctor has recovered, or this doctor in the fourth quarter is doing better than it was doing in the first quarter. Or if we look at the number of days they were closed, what would have their collections been if they were open the entire time? By doing that, we've taken the time to look at the circumstances of each individual practice versus taking a one-size-fits-all approach saying, okay, we're not going to count 2020. Everybody's going to use 2019 as the basis. For some doctors, that's probably fine. But the doctors who did really well in 2020 are going to miss the benefit of doing really well in 2020. And the doctors that are really struggling in 2020, they probably are going to be overvalued because 2019 may not be a good indication of value. We think this extra step is important, and so that's why we have changed our valuation methodology for the income method going forward. Let's talk about the asset approach. It's the third method we're going to talk about. So basically, we're going to value the assets of the practice. Tom talked about intangible and tangible assets, and that's exactly what we're going to value. We're going to value our tangible assets, and we're going to basically restate all the assets back to market value. So the tangible assets are the market value of equipment and technology, and the market value of supplies and inventory. The intangible assets are based on goodwill, and we use a goodwill registry, which is one of those databases we talked about earlier, to help us understand what goodwill had, the percentage of goodwill in prior transactions. We also use other practice factors to determine what our goodwill percentage is. So how do we calculate the final value? We've run these three methods. And so what we do is we get a value for the guideline transaction method, and then we add it to the discounted cash flow method value, and then we add that to the asset method value, and then we divide by 3, and that gives us the final value. We weight each of these methods equally. We feel like they all are important when we look at the value for a practice. Like I said in the very beginning, sometimes we may not use all 3 methods. In practices that are smaller, that discounted cash flow method may not be the right method to use. So we may just use a guideline transaction and asset method. But again, it is practice specific. So my next section is what affects the value of a dental practice. And why would you need to know that? One of the reasons that we suggest that practices have a valuation is so they understand what the value of their asset is, and that will help them make decisions whether they're going to sell now or maybe they're going to sell in the future. What you do prior to sale impacts the value of the practice, and knowing that will help a doctor make a good informed decision. So we're going to talk about basically 5 factors that impact the value of the practice. One of the biggest is area demographics. Doctors can't do much about that. The practices are already established where they are. But certainly understanding that will help them in planning. So whether a practice is urban or in a small town makes a big difference on values. Small town practices actually, in my experience, tend to be relatively profitable compared to sometimes the urban or suburban practices, but they do usually hold a lower value because there's a smaller buyer pool for them. And so practices in those areas tend to have slightly less value than in the areas that are more desirable. Diversified industries and area economics recent or planned commercial development and new housing starts. What is the economy in the area that you have your practice? A booming and a growing economy is going to create a hot market for a practice. Dental practices are driven by patients. So if new housing starts make a big deal because that's new patients for a dental practice. Collections, so revenue, how much money is coming through the door, impacts value. So there are a number of things to consider. One is whether you're reducing or increasing your days or hours and what impact that has on collections. It makes me really sad when I sit down with a doctor who says, I'm ready to sell my dental practice, and I'm all excited to do that. And then the doctor said, well, I used to work 5 days a week and the practice was doing great. And I made I had collections of X. But in the last 3 or 4 years, I've cut back and I'm only doing 2 days a week or 3 days a week. And that's fine, except what the doctor has done is reduce the value of his practice. And that may be okay with that doctor. But if the doctor didn't know that, the doctor made that decision without understanding the impact on the value of the practice. If the doctor had known that, maybe would have practiced a little longer, a few more days a week, and then sold the practice when it was worth a little more, or hired an associate to come in and work those additional hours that they wanted to cut back. And it's not that there's right or wrong choices, but it's understanding what decisions have the impact on the value. Insurance reimbursements, they impact your collections. Do you have an insurance plan that doesn't pay as well as others? If you're having trouble finding room for new patients or getting your patients in because you're so busy, maybe you ought to look at the insurances that don't reimburse as well. Types of procedures that you do. Henry Schein Dental has a practice analysis, and it will take a look at the procedures that you're doing and identify what procedures you might be missing, as well as give you a fee analysis, which will help you understand if your fees are in line with the fees in the area. Bringing in a specialist. If you're sending out a lot of your specialty work and you have room in your practice, maybe bringing a specialist in, a periodontist or an endodontist 1 day a week could help improve the collections. Adding or increasing hygiene. If you have room, the last statistic I read, for every hygiene dollar you bring in, it potentially creates $3 in doctor's collections. I mean, that's a huge increase in collections if you can increase your hygiene. Operating overhead, or how profitable your practice is. And we talked about that when we looked at practice A and practice B earlier. If your practice overhead is 50% versus 70%, that practice that has a 50% overhead is going to be more profitable. So here's some things to consider. Staff salaries are one of your largest expenses. If your staff salaries are 30 to 35% of collections, you're on the high end. You have two things you can do. One, you can increase your collections, and if you don't have to add staff, that you become more profitable. But two, if you've got long-term staff and they're valuable and they do a great job, when they leave, when you replace them with somebody at market rate. Don't replace them close to the rest of your staff salaries, because your staff salaries may be above market, because if they've been there a long time and every year you give them a raise, they may be higher than the current market. Staff benefits can impact overhead, and I'm not suggesting you don't give your staff benefits, but if your staff has medical insurance and they have pension, it may cause your overhead to go up a little bit. Rent is a fixed expense, so if your collections are higher, your usually percentage of rent to collections is lower, which is going to reduce your overhead. So take a look at your rent. Do you have excess capacity? Do you have operatories you're not using? Or can you expand in an operatory and add a hygienist? Because if you're paying rent on facilities you're not using, that is reducing the profitability of your practice. Lab fees and other purchase services. Take a look at what you're paying for them. Sometimes you stay with the same lab year after year because they do a great job, but you never renegotiate those fees. And then overall office expenses. Again, taking a look at the expenses that you spend on a regular basis. Is there a way to streamline them and increase your profitability? Facilities. So age of dental equipment and technology will impact the value in terms of evaluation. The number of treatment rooms, room for expansion, and overall condition of the office will impact the salability of your office. So if you're ready to put your practice on the market, you probably can't change the number of treatment rooms, but you certainly can improve the overall condition of your office. You know, if you haven't painted in a while, paint. If the carpets are dirty, clean them. Things that sound simple, but they do make a difference when a buyer is coming in. Technology is one that makes a difference in terms of some buyers. So if you are even partially digital, it'll make a difference to a younger buyer. They've never seen film-based. So there's a couple of things that you might want to consider in terms of technology. If you're going to sell your practice in the next 5 years, investing in large pieces of technology, unless it's going to earn you money today, may not be a good financial decision because of the depreciation recapture. But some smaller pieces of the technology might make a big difference. So for example, if you have computers, adding an intraoral camera usually helps case acceptance. If you have an X-ray and an X-ray can work with digital, you could add digital sensors versus adding a digital pan. Those things will help the salability of the practice and will also help the value of the practice. Current or former associates. Do you have an employment agreement? This impacts the value and the salability of a practice in two ways. We do recognize that some states do not allow restrictive covenants, but in the states that do, we may assess a greater risk if there's no restrictive covenant for a long-term associate with significant production. The ability of an associate to move next door and work for a competitor or set up their own practice is certainly going to impact salability. If an associate's already left, they may already be impacting your collections, and that would negatively impact your value. A lack of an employment agreement with a restricted covenant also may impact the ability to finance a purchaser to buy a practice. We always suggest you need an associate contract, and that contract should include a non-compete, non-solicitation clause, if legally allowed, and be transferable, meaning that if the assets of the practice are sold, the agreement can be transferred to the new buyer, or at a minimum, at least that non-compete stays in place. Every dentist should have an exit strategy. And we're going to talk about two kinds of exit strategy, a planned exit strategy and an emergency exit strategy. If it's planned, it doesn't have to be so specific that you have your exact date of sale picked out, but understand where you are in the process allows you to make informed decisions. For example, understanding what we talked about earlier, if you cut back your days or hours, you might be negatively impacting the value of your practice. That doesn't mean a doctor can't cut back. It just means they understand the future impact of making that decision. The second is an emergency strategy. So let's walk through that. Were you aware that only 30% of practices will sell within 90 days of death? Only an additional 10% will sell after 90 days. 60% of practices do not sell at all if the sale is delayed more than 90 days. These are really scary statistics, so let's talk about how we mitigate them. Protect your family by leaving a letter of instruction, stressing urgency to act immediately. Well, what's a letter of instruction? It's a document that you put together that has detailed information on your practice, which will help your family sell that asset in case something should happen to you. It includes hopefully the name of a broker. It would provide the name of your attorney, your accountant, maybe some passwords to your accounting system, any information that your family would need to continue to run that asset until they can sell it. And we have a document that literally walks you through the steps. You need to have the practice valued. And you may be saying, I'm not going to plan to sell anytime soon. Well, that's fine. But if you have an emergency need to sell the practice, having the practice values allows your family to move really quickly. Name a trusted transition broker in your letter of instruction. The very last thing you want your family to be doing is to be interviewing transition brokers in a time that everything will probably seem twice as hard. So if you've already done that in advance, you can put the name of that broker in there. Your family can call that broker and they hopefully can take care of everything. Do you have an emergency strategy? And my question to you would be, why not? Here's a copy or a picture of the front page of our letter of instruction. And at the end of this webinar, there is a link where you can download this fillable form. I'm now going to turn it back over to Tom. Thank you so much for your time this evening.
Thanks a lot, Eileen. You covered a lot of ground in a very comprehensive way, and I hope everyone understands why it's so important to factor all these points in to get a fair and realistic value. So now let's shift gears. We've dealt a lot with sales this year, a lot of emergency sales, where many older doctors, after COVID hit, their physician said, don't go back, it's too risky. Other doctors said, I don't want to deal with PPE or anything, I just went out. Sometimes the doctors, said, I don't care what I get from my practice. Maybe, I'm a tenant, maybe someone can take my lease over, or I just want to close my doors. Well, I've always had a problem with a doctor walking away from their career. Back in the day, people used to say, oh, yeah, I picked up Dr. Snyder's practice for $2,500. What a way to go. What a way to have your career end that way. So we've been pretty strong in advocating a couple of different methods that give a doctor who is going to be retiring and who's really not going to be selling the practice as a going concern, a way to get something for their life's effort. So let's talk about a couple methods. The first one is called a production or revenue acquisition valuation method. And in this case, what we're going to do is we're going to pay the seller a fixed percentage of receipts from any seller patients who visit the new practice, usually over a 2 or 3 year period. We recommend that the receipt ratio be 25% for 2 years and 20% for 3 years. But that is not cast in concrete, as they say. That is a negotiable number. But as you can see from this method, who's taking the risk in this particular method? It's the seller, not the purchaser. So what do? We negotiate an initial down payment, and we'll give you an example in a minute to see how the mathematics works. But from that point forward, we need to come up with a value. We're not going to do a traditional valuation. We're basically going to use a revenue multiplier. And what we try to get our sellers is 75% of the average weighted revenue over the last 3 years. Now, that 75% is a stop point. It's not what the purchaser is going to have to pay. They will only pay that 75% of the average weighted revenue if, in fact, the patients come to the practice in the next 2 to 3 years. And there may be some of you in the audience tonight who've acquired practices like this and really did extremely well. In the revenue acquisition method, payments are typically made quarterly because there's some math that has to be done, and we recommend that's the way it works. We also suggest that the seller has an option for an annual audit. So because we're going to have to code patients, we want to make sure that the tracking is done properly. So again, it's up to the seller to request that an audit be done by a transition consultant and or an accountant. So let's look at the mathematics. I think this will put it in clearer perspective. Let's assume on the left that the weighted revenue for the 3-year period was $300,000. And we negotiate a ratio of 75% for a sale price of $225,000. We suggest that sale price be paid over 3 years. We're going to use a 20% payout, and we're going to request a $25,000 down payment. Now, let's look on the right side. In year 1, the purchaser collected $360,000 from that patient list. All those patients came, additional services were provided, whatever the case may be. But if you're doing the math, you're saying, well, 20% of 360 is 72,000. But remember, the seller, got a $25,000 down payment. So in year 1, they only pay 47,000. So basically, the way this works, you pay down the down payment, and then the percentage kicks in. Year 2, the practice grew to 400. The seller got 80,000. Year 3 grew to 430. The seller got 73,000. So you're wondering, Tom made a mistake with his math. No, it's because when we reach the $225,000 number, the payments stop. That's fair. Now, conversely, if the example was not so rosy and the numbers were in the high 2s, then you would not even see anything near 225,000. So we feel this is an ideal win-win scenario. If this practice really has opportunity, the seller can get a reasonable amount of money. And from the buyer's point of view, he or she's picked up a tremendously well-performing asset. Now, some of you may not want to go through that mathematics and that kind of tracking. So another more simplified approach is what's called an individual record purchase. So what we again look is the average last 3 years of revenue. We divide the number of patients who had one patient visit into that number, and we calculate a per patient record fee. Typically, these payments are made over 18 to 24 months, and we recommend that the record fee be paid after the second visit. Again, quick math example. We have the average revenue on the left for 3 years at $211,666. There were 800 active patients by our definition. So dividing the 211,666 into 800, we come up with a per record value of $265, which will be paid on the second visit. Again, these are two methods that at least give the selling doctor something for their life's work. And quite frankly, for a purchasing doctor, a very cost-effective way to build up their existing patient base. So we covered a lot of ground tonight. And I think from what I've said at the outset, I think it's a fair thing to say that our profession has fared pretty well through the pandemic. Although there were some dark days and we're all feeling pretty low, but things have really come back. And I think many of you are heading into a very good year in 2021, not just from what you experienced when you opened the doors when patients came back in, but you're finding the fact that 88% of patients out there want to see you. That's still a good sign. And as these vaccines continue to proliferate, we're going to get back to 100%. So it's conceivable that your value may be at least what it was in 19, or depending on how you're doing, slightly better. We also know that the approach that we're taking is a little more deliberate and a little more analytical, but to be fair to everyone, we really need to drill down to make sure when we're valuing a practice that we're not undervaluing it or overvaluing it. And if you look at a purchaser, many of the purchasers, especially this year, they were petrified by, gee, if I can't pay this full price, this practice is heading in the wrong direction. Well, by some of the things that we're doing, we're going to try to reinforce the positive and show that purchaser that things are going well. And by the way, lenders are going through a similar exercise with looking at data so that they can, with confidence, loan full value. And we've seen that quite a bit, as long as the due diligence is done in a proper fashion. So as Eileen mentioned, you can download a complimentary letter of instruction by visiting our website or emailing at ppt@henryschein.com or simply calling our corporate office at 988-5674. Eileen and I want to thank you for the time that you've spent with us this evening and hope that you have a better insight and understanding of practice values, and that we hope that you take advantage of looking at this particular document and taking action, and also getting a valuation done if you had not had one done recently.
Tom and Eileen, thank you for your time this evening. If anyone has additional questions about tonight's topic, please email ppt@henryschein.com. Additionally, if you are interested in attending future Henry Schein webinars, visit henryscheindental.com/webinars for our upcoming schedule. As a thank you for attending tonight, everyone will receive this recording in the coming week via email. Thank you all for joining us, and we look forward to seeing you back here soon.